Finally, assume the new product line is expected to decrease sales of the firm's other product lines by $50,000 per year. Okay, so first off, is this incremental? It definitely is, right? That reduction in existing sales will not happen, or is not anticipated to happen, unless we do this new project. So we do the project, it has its impact. We don't do it, it doesn't have the impact. That means it's incremental, and it has to be in our analysis. But what is it? So it's not a sunk cost, we know that. It's actually, it looks like it must be an opportunity cost, but it's not. It's something a little bit different. It's kind of like an opportunity cost, but it isn't different enough to give it a different name. So what is this thing? This thing is what we refer to as an externality. That's something you guys have had in economics. So externalities, they can either be positive or negative. A positive means it has a good impact external to the project. So in other words, externality, it has an impact external to the project itself, okay? Externality. They can either be positive or negative. So it has a positive impact on the rest of our business, it has a negative impact on the rest of our business. Externalities are sometimes referred to as spillovers. So spillover benefit or spillover cost, depending on whether it's a positive or negative externality. Spillover, it's a common thing to call it a spillover instead of externality, because what it's saying is this project, its benefits directly in the project will spill over into other areas of our firm. Let me bring you guys up. Let me see if I can find it. Here we go. We're going to go back and answer one in the mini case in just a minute. So let me show you this. This is getting to be a little bit old article, but it's kind of interesting. This was in Forbes a while back when a little bit after the iPad first came out from Apple. This is 2011. The iPads came out, I don't know, around 2009, plus or minus a year, somewhere in that range. And then Amazon came out with the Kindle Fire, right? So that was their low cost, their poor man's alternative to the iPad, right? iPads were going at a minimum of $500 a pop, and so Jeff Bezos said, we're not going to sell a Kindle Fire for anything more than $199 each. So this analyst did some analysis and estimated. So first thing is, this was this analyst estimate, but it's probably pretty darn close. Everything it took to build an Amazon Fire, $209.63. But Jeff Bezos was selling each one of these for $199 a pop. So he was receiving revenue per unit of $199, and all of his operating costs were $209.63. So his operating profit, his EBIT per unit, he was losing $10.63 a unit, times however many millions and millions of Kindle Fires he was selling. So Jeff Bezos must be a really stupid man. He's too rich to be that dumb. So what was this analysis missing? What were the possible externalities or spillovers?
Purchases of books.
E-books, right? You use a Kindle Fire as an e-reader, you buy more e-books, maybe more apps. That wasn't in this person's analysis. I bet you if you went back and put in expected increase in e-book sales and app sales, you would get enough extra revenue where this turns positive, pretty massively. Like what if they said an extra $30 a year in e-book revenue per Kindle Fire, an extra $5 a year in app revenue, so 35 extra total. So we should have added another 35 up here per Kindle Fire because of these externalities, how it spills over into other areas of business and increases existing sales, right? So that was the impetus of the Kindle Fire. It wasn't that it's valuable in and of itself, it's what it does to their existing business, how it impacts that. So that's the incremental cash flows there.
So that cash flow, that $35 cash flow is from the analysis of a different,
How it impacts other areas of the firm,
okay.
right? So a lot of times we say, okay, when we do this project, we're looking at the project in isolation, don't worry about the rest of the firm. But that ignores that the project might actually affect the rest of the firm and change it from where it's at right now. And we need to know that change, and that's what that 35 is, the change. How much extra ebook sales we get with the Kindle Fire sold versus without them sold, right? That's what we're getting. And so they estimated that at Amazon, and they decided to go ahead because they actually had that analysis in there, whereas the analysts did not. They were leaving out the externalities. So externalities can be positive, like the Kindle Fire and app sales and ebook sales, or it could be negative, like Gatorade. So you guys know the backstory in Gatorade, right? So it was created by, it's one of the football personnel, maybe one of the, I don't know who it was, in University of Florida's athletic department, in their football department, back, I can't remember if it's the 50s or 60s, a long time ago. And you know what they call their football field? Who knows?
The swamp?
It's a swamp, right? It's a swamp because it's humid as you know what. So people basically go into the swamp and they die after they played about a half of football. So, you know, if you could find a way to keep your players hydrated, and basic water doesn't do a whole lot of good when it's 100 degrees and, you know, 90% relative humidity out, right? You'll sweat that out and start getting cramps. So one of their people in the University of Florida came up on their own with Gatorade, ergo the name Gatorade. And, you know, it's meant to keep you, you know, hydrated better than just plain water. I don't know if I never thought of this until I don't know if they like the original green color, if that was meant because it was Gatorade or not. Probably so, instead of using like fruit punch or something. So, but they did that, and eventually whoever that individual was, I have to go, you guys will probably be curious and Google that up at some point, went and split off, left the University of Florida and marketed that stuff on the national level, and it became Gatorade, right? So that's where you got the name for it. But over time, what? They went from the original green drink to other kinds of already pre-done drink, to powder, make yours at home, to the gummy bear stuff, like, you know, I'm gonna be a runner, I don't wanna carry, you know, a gallon of liquid with me, I'll take a bunch of gummies with me instead, that'll keep me going. So, but here's the thing, so the Gatorade Light. So what if Gatorade, when they were looking at the light drink before they actually started producing it, they're doing the analysis, should we make this stuff or not? What do they have to figure out? Will there be a spillover to the rest of our existing business? Now, if you do the Gatorade Light, would the spillover be positive or negative? Likely negative, because if people buy the light drink, they might buy less of the other products, and that has a reduction in sales in the existing business that has to be anticipated and brought in. So instead of plus 35, maybe it's a minus 35, right? So it works kind of like that. So externalities can be positive, they have a positive impact on the rest of the business, or negative, they have a negative impact. But it's spillover. It's the project affects the rest of the existing business and changes the existing business from what it would have been without this thing. If we go back to the mini case, they say, assuming new product lines expect to decrease sales of firm's other product lines by $50,000 per year. That is an externality or spillover, and it's a negative one, right? That's a negative externality right there. So we can see what that is. Let me ask you guys, what did we say last week that we should do with the interest expense, or if they had dividends that they would pay, they would increase, they're going to increase dividends and they're going to have to pay interest if they do this project. What did we say about that? Remember? We leave it out, right? We ignore it. And why? The authors say it's because you're double counting, because you're using the WACC as a discount rate, and the WACC already adjusts for interest. I've always hated that that explanation. My view is you don't include it because those are uses of cash flow. They're not sources of cash flow, right? If anything's a use of cash flow, paying creditors interest or principal, paying shareholders dividends or stock buybacks, or building up non-operating assets, none of those should be deducted in order to get your cash flow. They're uses of cash flow, right? So you don't deduct them to get your cash flows and then to get your NPV. They are uses of cash flow. All right, so let's see. Interest, dividends, any financing charge stays out, it's ignored. Sunk costs are ignored. Opportunity costs and externalities are incremental, and they both have to be included, but they're a little bit different from each other. So a little bit of an art is to recognize an opportunity cost and how it, how it's different from an externality. All right, let's see. One thing that we left out, what did we leave out last week in this thing? You guys remember? We left something out, and I said we'd pick it back up this week and see what impact it has. Inflation, bingo, it was inflation. So let's see, let's go back up here to the narrative. They say, let's see, sales price and cost. Let's see, so the sales price is going to be $200 a unit, and the cost is going to be $100 per unit, right? So there's that data. And what we left out last week is sales price and cost are both expected to increase at 3% a year due to inflation, okay? So we left that out. We're about to go and incorporate inflation into the analysis now, okay? So let me go back up here. All I did was, so we can speed it up a bit, I put everything into an Excel spreadsheet. Right, that's what you should be doing in capital budgeting cash flows, is use Excel. That's what it's there for. So, and real quick, so let's see, we're doing 1,000 units a year at $200 a unit. We had costs of $100 a unit. And these were our cash flows. I think we had a negative NPV last week, if I remember correctly. Didn't we? I think we had like minus 121,000 some odd dollars. I'd have to go back and look and see our cash flow numbers. I may have messed something up because I was running it back on the spreadsheet before I got in here, and it came out to be positive 32,741. So let's blow this up a little bit more here. There we go. So 32,741 is the end. So that's actually a good project now, right? That looks good. Now let's go and see what happens if we include inflation in this. So it said, let's do this one. Okay, so now we can see everything. So inflation is going to be 3% on our selling price and 3%. So you see what just happened to my revenue each year? It's gone up by basically 3% a year, right? I'm not increasing my number of units sold, but the price is going up because of inflation, so my revenue's gone up. It went up exactly the inflation rate, 3% a year. I'm gonna do the same thing in my cost. My operating expense should go up by 3% a year as well. And sure enough, there we go. If you're saying, why didn't this go up another 6,000 in year 3, right here, or another 3,000 here? Compounding, right? Compounding. So it works with prices and inflation just like it does with everything else in the finance universe. So revenue's going up at the rate of inflation, so are our expenses. Let me get rid of that. Let's put that back at 0 real quick. We'll see why. Let's write that number down, 32,741. So, NPV without inflation. 32,741. Okay. Let's go add inflation, both in our output price and our input prices. And now, with inflation, we've got an NPV of 42,452. You say, why did that just make this thing more valuable when both our revenue is going up by 3% a year and our expenses are going up by 3% a year? Why would that make the NPV go up? Because the difference in them is that net margin, right? So remember, you take your sell price, 200. This is going to be year one, minus your cost per unit. This is per unit, minus 100. That means you've got $100. What do they call that in marketing? They call that your contribution margin, right? So your contribution margin. Per unit, how many dollars are you basically profiting per unit? $100, right? We're profiting $100 per unit. But by year two, we're at 206 there, right? It's gone up 3%. And we're at 103 there, we've gone up 3%. Each has gone up 3%. Well, look what's happened to our contribution margin. It's gone up. So that's 3% higher. So not only are our revenue and our costs going up 3%, so is our profit. And because of that, and also some of our costs are fixed, right? So those fixed costs aren't going up with inflation. They're fixed. So even if you have the same inflation rate in your output price and your input prices, that doesn't mean that that having inflation is going to not have an impact on your NPV. It will, because your profits are going to go up, right? The difference in those numbers. They're going to go up even faster if some of your expenses are fixed instead of variable, right? So those won't go up with inflation. So to some extent, inflation can be beneficial for a business, right? Their costs go up, but the prices go up, and that means their profit margin goes up with it, and that's going to increase the NPV. Could it be detrimental? Yeah, prices go up too much, people buy less stuff, so the quantity sold goes down, and that could offset it. We didn't have that here, right? But we could envision something like that happening. So this is the number that we should, if we had done the analysis completely last week, that's what we would have got right there, 42,452. This number right here, so let's put up here. If our cash flows have no inflation, let's see, I'm going to do this. If we take our cash flows and we adjust for inflation, that's what we did here. Right, that's that. We call these nominal cash flows. You guys have heard that term before, nominal, right? It's got a real rate and an inflation rate, nominal. So these are nominal cash flows. They have the effects of inflation included in them. If you don't have any inflation adjustment, or you could say inflation is taken out, you get what's called real cash flows. So what that means is what we did last week, our free cash flows that we used last week were real. Not real as in the company will really earn them, real as in we didn't adjust for inflation. No inflation adjustment. The ones we did today here were nominal cash flows, okay? Now, which of those two procedures with our cash flows are correct? Either one's okay. But which one you use, you've got to adjust your discount rate as well. So, we had a WACC of 10%. And this WACC will say, if it doesn't tell you, then it's a nominal WACC. Interest rates can be nominal or real as well. So, a nominal rate is composed of a real rate. I'll put a little squiggly, approximate, okay? Not exact, but pretty close. A real rate plus an inflation rate. That's the approximate relationship, and that makes intuitive sense. So if we said, for example, my nominal rate, my nominal discount rate is 10%, but the inflation rate is 3%, then the real rate must have been 7%, right? Something like that, approximate. I'm going to give you an exact approach in a minute, but that's generally pretty close. So what does that mean? It means if we come over here, and today, what did I use to discount? I used 10%. I know you didn't see it in there. I had to go check my EPV formula, but I used 10%. Okay? So I used 10%, which was my nominal WACC. If you use nominal cash flows, they have inflation in them, you need the nominal WACC. It's got inflation in it. How do you know if you have a nominal WACC? It's typically the one that's given to you as the cost of capital, nominal WACC. If you don't adjust the cash flows for inflation, they're real, then you need to be using a real WACC, which in this case would be approximately 7%. So, can I use real or nominal cash flows? So I have to use one or the other? I can use either, but then I have to use the appropriate discount rate with it. If I use real cash flows, I have to use a real discount rate. If I use nominal cash flows, I have to use the nominal discount rate. Okay? So I can see that this approach here is okay. Nominal and nominal. That works. This was flawed. Oops, excuse me. What did we do last week? Last week, we had a nominal WACC, 10%, but with real cash flows. I mixed these two. That was flawed. What could I have done? I could have taken real cash flows with my 7% real WACC. And let's see what happens then. Let's get inflation out of this. Now, again, this is an approximation. It's not going to be quite 7% real rate. It's going to be a little bit different. Not everything, not all of my costs are moving with inflation. Some are fixed, like depreciation. That's going to skew it some too. But still, let's look and see. Let's make inflation 0. And let me go back and let me change my discount rate. I'm going to put it right here. 10% is going to be my discount rate. Okay, here's my WACC. And let's have that reference it right there. Okay, so let's see, let's put that back in. Okay, so there's my 40,000. That's interesting. 4450. That should have been a 4452 instead of 42. But you get the basic idea. Did you see that before?
Yeah.
You didn't tell me.
Oh,
So I need you guys to keep me honest. So remember, my Tuesdays are my Mondays are your Tuesdays. Something like that. So 40,452, right? So nominal, that's correct. If I didn't have inflation, then I should have come down here and put in 7%. That's not going to be the same. Why? because that's approximate. It's a little bit different than 7% because all my costs are going up at that rate. But that would have been, it's higher though. Basically what it's telling me is, so I could have done that. So that's 53,207. That's legit as well. What if I had taken a real cash flow and used a nominal, let's see, we did that right there. Right, so we had real and nominal, kind of, it looked good, but it undervalued it, basically. We had nominal, nominal, real, real. What's the other combination we could have? Yeah, so nominal cash flows, and then a real discount rate. Our cash flows would be higher because of inflation. Our discount rate would be lower because we stripped out inflation. So we use 7% here. That's probably gonna make this too large. It's probably gonna expand the NPV way more than it should. So here, let's see, we want nominal cash flows, 3% and 3%. Oop. Change that back. 3 and 3, and then this is going to be 10% here. No, 7%. Way too high now, right? It's completely overvalued it. So the basic premise is that, you know, like I said, if I use an exact number for the real rate, and I'll show you how you get that in a second, and if I didn't have any cost that were fixed, if all my costs moved with inflation, then this approach and this approach would give me the exact same outcome. So it wouldn't have mattered a bit which method I used. Entirely arbitrary, just as long as I'm matching nominal to nominal or real to real. That's the big thing right here. Why do we stress this? Because it happens a lot of times, analysts aren't aware of this when they get out. And what do? They don't include inflationary effects in their cash flows, but they have it in their discount rate. And so they're mixing these two without even realizing it. And the common error is they do this right here. They forget to include inflation here, but it's implicitly in the WACC here. They've undervalued the project. That's the common error we tend to find. Okay, let's put that back at 10%. All right, we've got our nominal cash flows in here. All right, so we've scooted through that part of the chapter. Let's get into the risk part real quick, okay? So I've got some slides in this, but let's just do this on the board up here. And we're gonna see some of it with this exact same mini case, all right? So we're gonna look at project risk. So what did I say before in the cost of capital chapter? I said we should adjust the discount rate for the risk of the project. Remember that? We don't use the WACC, we use the discount rate. If the project's riskier, we should use a higher discount rate. If it's less risky, a lower discount rate. But it should vary. There's actually, that may not always be true. So let's think about this real quick. You're in Jadici's class. Who's in Jadici's course? Bunch of you poor unfortunate souls. So Jadici would say, you know, for a portfolio, you know, or for a security, we're going to put this security in a portfolio. We can split the risk of that security into two elements. Total risk equals what and what? Systematic risk, and what's the other? Diversifiable or non-systematic, or any number of terms, right? So you've got systematic risk. No, your systematic or market risk, you can't diversify it away. And then you've got your diversifiable. Your non-systematic, or they even call it idiosyncratic. Random, right? It's almost like it's random. It disappears in a larger portfolio. So that's what he taught you guys, is that the total risk of the security doesn't matter in the portfolio, only the systematic stuff does, because that's what changes the risk profile of your portfolio, is the systematic risk, right? Does that work for projects as well? You betcha it does. Now, how do you measure systematic risk? You guys learned this in 3333. Use beta, right? You adjust the discount rate. When systematic risk is higher, you go through CAPM, you're going to have a higher discount rate because your beta is higher. When systematic risk is lower, you have a lower beta, a lower discount rate. So this is going to affect your beta, and that's going to affect your discount rate. So one way to adjust for project risk is what I've already told you guys in the prior chapter. You can adjust the discount rate. It goes up or down with the riskiness of the project, but the systematic risk, the risk we can't get rid of, right? So with that, this is sometimes referred to as a risk-adjusted discount rate. It's also referred to, and I'll kind of asterisk and circle this one, it's also referred to as a hurdle rate. A hurdle rate is simply a discount rate that is higher for risky projects and lower for less risky projects, but specifically systematic risk. We're going to come back and think. So the key part here is I'm probably going to use CAPM to do this, right? So we'll probably use CAPM. So in CAPM, I know I've got a risk-free rate, I've got a market risk premium, and I've got a beta, and the beta is the only thing specific to that project, right? So a question becomes here, where do we get that beta? Remember in that homework I gave you guys GE, and it had those, 4 divisions? Right, aviation, healthcare, power, and something else in there. And they each had a different beta, a different level of systematic risk. So a good question would be, where in the world did you get those 4 different betas for those 4 different divisions in GE? Or put differently, if you were running GE, how would you get the beta for those divisions? How would you get the beta for a new product line? How would you do that? So there's 2 ways to get this beta right here. You can use what's called a pure play, and this is the most common method. So what's a pure play? A pure play, you try to go out and find a company that's doing what you're going to do, or what your division does, or what this product will do, and you estimate the riskiness of that firm. You strip out the effects of debt, right? There are ways to do that. We'll see that later in the course, how to get rid of the effects of debt and beta. And you've got what's called an unlevered beta, a beta without any debt effects in it. Debt makes things riskier, right? So get rid of that. But just a firm, like, what if I'm going to do a company that does rideshare? We've already got a couple of examples, right? We've got Uber and Lyft. So I'm going to go and look at the beta for Uber and the beta for Lyft. Let's say that they're 1.5 and 1.7 respectively, but each have some debt. So when I adjust them for the debt, strip out the effects of the debt, it's going to drop their 2 betas down to 1.2 and 1.3. I'm probably going to use 1.25 in average. That's going to be my pure play beta. That's pretty simple. As long as I can find something that mimics what I'm going to do, right? That's the basic premise there. I've got to be able to find something that mimics what I'm going to do, and that's a pure play beta. It's a very common procedure to do it. What's another approach? This one is mentioned, but I see it used a lot less in practice. It's called an accounting beta. An accounting beta would be, I can't find another firm that's doing what this project will do. Like, I'm about to go public with Uber back before Lyft had gone public, when I'm going to be the only game in town worldwide doing rideshare. How in the world do I estimate my beta when no one else has done this? I do what's called an accounting beta. I look at the cash flows from my project that I've estimated, and I see how they're correlated with the overall market returns. Beta would basically be looking at how a stock moves with the overall market. That's in Judici's course, right? If they move in the same direction, the beta is positive. If they move opposite, beta is negative. If your stock tends to be a lot more volatile than the market, beta's above 1. If the market's more volatile than your stock, beta's below 1. If there's no relationship at all, beta's 0. Could you do the same thing with the project? Take your cash flows and look at how they relate or correlate with the market itself? In theory, you could, and that would be an accounting beta. I see it done a lot less than the pure play beta, but it is a possibility. So that's what you do there. So that's all about adjusting the discount rate. And we've already done this. You guys did this in that assignment. So what you would do is you would get your beta, you would run that into CAPM, and then you would run that into your WACC formula. But this is going to be the WACC for your project, and that's going to be called your hurdle rate. Right? It's not the firm's cost of capital anymore. That's your risk-adjusted discount rate or your hurdle rate. Now, what if the risk is diversifiable? In Giudici's course, he would say, from a portfolio context or from an investor's standpoint, it doesn't matter, you diversify it away, so you can completely ignore it. And that's the correct approach. But what if you're running a firm? What if you're the CEO of Uber, and most of your risk in your project is diversifiable risk? Does that mean you face no risk in Uber? Because if you did, you could borrow a ton of money and never have to worry about paying it off because you have no risk. That'd be fantastic. They have risk, right? It may be diversifiable, but from the firm standpoint, they face risk. And even though it's idiosyncratic or diversifiable risk, it can still get them into trouble and bankrupt them, right? So firms, unlike investors, firms have to be aware of both systematic risk and diversifiable risk. They've got to be aware of it because diversifiable risk can wipe a firm out and drive it under. So what do you do here? You don't adjust the discount rate, that's only if it's systematic. What do you do here? Here, this is going to be reflected in your free cash flow estimates. That's something they didn't tell you in the chapter. So that's an extra I'm throwing in that the authors of the textbook don't have. So you've got these two ways of looking at this. If I'm adjusting my discount rate, I'm implicitly saying that risk I can't diversify with, it's systematic. If I say the risk that I'm exposed to is diversifiable, I have to adjust my cash flows to account for it. If I do that, I've got several approaches to do this. Approach number one would be something called sensitivity analysis. And we're going to see these in a second. It's going to be pretty quick to do them. So sensitivity analysis is one. A second method to adjust the cash flows is scenario analysis. And then a third is simulation analysis. And usually I bring my computer for this because I've got a package on there where I can run a simulation and show you what would happen. And I completely forgot to bring that today. So I have to show you a slide or something that shows you and just try to describe what's going on. It may not be too successful. If not, we can do it real quick on Thursday. We'll spend 5 minutes and I'll show you what happens. So I'll have it then, okay? So let's look at those three things right there. Sensitivity, scenario, and simulation analysis. All right, let's go back to the mini case. And let me find, okay. Let's see. Down here in part J, what sensitivity analysis we're about to find out. But it says perform sensitivity analysis. Perform it on the cost per unit, on unit sales and salvage value. It says do so by varying the values from their base case or expected by plus or minus 10%, 20%, and 30%. Well, you know what? We don't have to do all that. they're making it a lot harder than what they need to. To do sensitivity analysis, all we need to do is just arbitrary some percent change in one input, leaving everything else as it was. And then reset that input and then do the same percent change to another input, right? So what percent change? 10%, right? 10% is common. Could I use 100%? I could. Could I use 7%? I could. But I want to use the same percent change in every input, okay? So let's just do, I don't need to do plus or minus. Let's just do plus. It'll show me everything I need. Let's do a plus 10% change to, so let's see, and let's put up here our base case NPV. Let's see what we've got. So they want to do unit, cost per unit. So we called that V last week. We know that this was 100, so 10% increase will be $110, right? We're going to increase that to 110. They say, let's look at unit sales, Q, the number of units. That was 1,000, so I know that a 10% increase to that will be 1,100 units. They say salvage value. The salvage value for this thing was, how much? Had a salvage value of $25,000 after 4 years, okay? So salvage value was 25,000, so a 10% increase in that would be 27,500, just 10% higher, okay? Those are my new values. So let's minimize that. Let's go back to our spreadsheet. So I'm going to keep inflation in this, okay? So here's my base analysis. I've got my nominal cash flows growing at 3% with inflation. I've got my nominal discount rate at 10%, and my NPV was 40,452. So let's keep track of that. 40,452. That's my nominal, or my base NPV, okay? Base case. My original inputs. Now what I'm going to do is this. I'm going to go and change my variable cost from 100 to 110. That's all I'm going to do. So let's come up here and let's make my variable cost 10. Right? I shouldn't need to do that, but it's now 20,630 down there. Okay? So that means my NPV is now 20,630. I increase my cost, everything else left constant, and my project doesn't look as good. That kind of makes sense, right? Same revenues, but higher expenses, lower NPV. In fact, by how much lower? Let's see. It's now that, it was that, so 20,630 relative to 40,452. It is now minus 49% change. A 10% increase in cost reduces NPV by 49%. You see how sensitive NPV is to that one change, okay? Let's go back and let's reset that. Let's put cost back at 100 a unit, okay? Back at my original, so my NPV is 40,452, my base number. Let's go do this one. Let's change unit sales from 1,000 to 1,100. So let's make that 1,100. Each period, 59,482 is my NPV. So that 59,482 relative to my base NPV, 59,482. And this is now 47% change to NPV. Against the base NPV. It's now 47% higher. A 10% increase in units sold leads to a 47% increase in NPV. I'm seeing how sensitive NPV is to each change, but I'm only making a single change. Okay, let's go back and reset that back to the original 1,000. Right? So I've got my original unit sold, original cost. Let's go change my salvage value from 25,000 to 2,750. Everything else at the original input values. So let's see, where am I picking that up? Oh, that's not slide. Give me a second here. Broke one of my rules of using a spreadsheet. I hard coded some numbers in there. So there's the salvage value. Okay? Let's change that to 2,750 or 2,750. 41,477. Okay? Again, everything else was reset to the original values. So 41,477 relative to the base NPV is a mere 2.5% increase in NPV. I increased salvage value by 10% and NPV went up by 2.5%. Not much. I increased my variable cost by 10%, NPV went down 49%, almost cut in half. I increased units sold by 10% and NPV went up by 47%, pretty sensitive. NPV was pretty sensitive to a change in cost and to a change in units sold. It wasn't very sensitive to salvage value, right? Now, how would this work? How would this help me? Am I saying that I'm going to get just a 10% increase in variable cost? Nah, that's not very realistic. Because if I had something like that, it'd probably be a number of things changing, right? If my cost changed. What I'm doing is simply asking which inputs are most critical. They're the ones that my NPV is most sensitive to. So in other words, you guys, I've hired you on to do this analysis for me, right? I've hired you on in my corporate finance department, and you're doing capital budgeting, and you want to go back and you want to, before you come to me with your output from this analysis, you want to go back and double check some of your figures. Do you need to go spend a lot of time double checking your salvage value estimate? Nah, because it doesn't do much, right? A 10% change here, a 2.5% change here, it doesn't matter much. But these two guys right here, you bet you, right? These have a disproportionately large effect right here. You definitely want to do those. Could you do this on all the other inputs as well? You could. So we could go and we could look and see how sensitive NPV would be if we, for example, changed the WACC by plus or minus. And by the way, I don't have to do 10%. I could do 5%, right, or 20%, whatever. So as long as a consistent change to each input. So I can go look at this and see, for example, if I look at my unit price, which was 200 originally, and change that by some amount, I can see I get a lot bigger change in NPV than if, for example, NPV goes up by almost 80% if the price goes up. If the price goes down 10%, NPV goes down almost 80%. That's a big impact. It's very sensitive to output price. It's pretty sensitive to variable cost. It's pretty sensitive to units sold, to Q. Hardly sensitive to salvage value. Not terribly sensitive to the WACC, right? So I know where to spend most of my time double checking my numbers and getting better estimates. That's the benefit of sensitivity analysis. It doesn't tell you this is going to happen. It's showing you which are the more critical inputs in your analysis. That's what it does. Now, what if I have an idea that multiple, I've got my base case, right? So I'm going to sell my product at $200 a unit. It's going to cost me $100 a unit. We're going to sell 1,000 units a year. Inflation is going to be 3% on both the price side and the cost side. All the various things. That might be given we might think the economy is going to be kind of average. And the product and the product acceptance is gonna be kind of average. What if the economy, goes into recession and or the product acceptance is not very good? Like somebody else beats us to the punch and they have a product that does better than ours, and they get there first. No one's gonna buy our product, right? They might buy some, but not as much. We might have to sell it at a lower price, things like that. That's a scenario. A scenario is a package of a multiple set of input changes that reflect some kind of economic assumption that's going on. Like if you're an oil and gas firm, it might be high oil prices, and maybe a low regulatory environment with high oil prices, or low oil prices and a high regulatory environment. That might change a lot of different things, like demand for oil, cost of pumping out oil. All those things might be changed fairly significantly and change the NPV of this oil field you're looking at. So let's look at, and this is what's going to be called scenario analysis. So scenarios are where you do different packages of changes in multiple inputs, each with a different scenario. So let's see how we're going to do this. Let's go back to our case here. Let's go find it where they're talking about scenarios. Okay, it's right here. It's in part K. Okay, so let's see. Confident of the estimates for all variables except for unit sales and sales price. Okay, and they're saying if product acceptance is poor, unit sales be 800 a year at a price of 160. So that's going to be poor acceptance. Let's keep track of this real quick. Let's keep this over here. So let's see. So scenario, poor acceptance. We're saying that price per unit will only be 160 a unit, and we're saying that the quantity sold will be 800. Okay. So what we're going to do? We're going to leave all the original inputs. We're going to change those two things right there. Let's go and do it, and let's get our NPV. All right, so I want to change quantity from 1,000 down to 800. And I want to change output price from 200 down to 160. And I want to increase that so we can actually see what we're doing. There we go. A little bit better. And I want to get the NPV, minus 58,746. Okay? So we want down here our NPV, minus 58,746. Okay. Remember, we had a base case, and the base case was 200 here, 1,000 units here, and the NPV was 40,452, right? Those are two scenarios. Let's go back to the narrative. There was a third scenario that I skipped over. Let's find out what it is. It says, there is the possibility of strong consumer response. That's another scenario. We have, in that case, unit sales 1,200 at a price of 240. There's some other data we'll get in a minute. So strong acceptance, 240 a unit, 1,200 units. Let's plug those in and see what the NPV is, okay? So let's go back to our spreadsheet. Let's put in 1,200 units at a price of 240, and we're gonna get 172,781. Big change, okay? 172,781. We got three NPVs. One's bad, the other two look good, one really good. So how do I do this? What do I do? Well, they give us some other data. They said, Sydney believes there's a 25% chance of poor acceptance. So probability, 0.25. And that there is a 25% chance of excellent. That's a strong response, all right? So probability over here, 25. And if I kind of went over the next page, they'd say and a 50% chance of average acceptance. So what I'm gonna do now is I'm gonna take NPV and multiply it by probability. Minus 58 times 25%. 40,000 times 50%. 172 times 25%, okay? So let's see what we get here. This is gonna be minus 14,687, first one. Second product is going to be 20,226. The second product, or the last product over there, is going to be 43,195. And what I want to do is take these right here and get the sum. And that is going to be 48,735. And that is referred to as an expected NPV. You take the NPV from each of your scenarios times the probability of each scenario, then add up those products, and that's an expected NPV, okay? Expected NPVs come up when you have multiple scenarios. What do I do here? How do I evaluate this project? I don't use this. I don't use any of this stuff right here. I use this number right down here. What do you think the decision should be? Accept it, right? Because the expected NPV is positive. Use expected. So I don't want to go and say, well, I'm going to accept the project as long as it's, average or strong acceptance, but I won't accept it if there's poor. Because I don't know. That's the future. I have to decide today. I won't know what the acceptance is going to be until it's actually happened. It might be different than these. So what do I do today? I realize there's different possible outcomes. One looks pretty bad. But overall, it's saying that the average effect, taking all this into consideration, both the different scenarios and their likelihood of occurring, a positive expected outcome, I should make this investment. Positive expected NPV. So again, this is where you've got some diversifiable risk, but you alter the cash flow. So this is the principal way that we go and adjust for diversifiable risk, is to do scenario analysis. And we adjust the cash flows, right? This will have adjusted the cash flows, and that's what adjusted the NPV in each of these. I only did 3 scenarios though. That sounds kind of coarse. Are there more possibilities than that? You betcha, right? What might have been nice if I went back to kind of my stats and I said, you know what? There probably isn't 3 different possible scenarios for product demand. There might be an infinite number of possible scenarios, right? Which I can't. I'm not going to do an infinite number of scenarios. I'll be here forever. So how do I do this? Well, what if instead of saying like, in strong demand, price is $240 and unit sales is $1,200, what if I say the following? What if I think that demand looks like a normal distribution with a mean value, a most likely value of 200, my base case, and a certain standard deviation. And then I go and I pull out of a distribution. It's like drawing out of a hat, but it's not equal chance. It's this normal distribution. I randomly draw out of something that has a distribution like that, bell curve. And maybe the first time I draw out, I get a number over here for price. And I plug that in, and I do another distribution for unit sales. Maybe unit sales looks like this. Maybe unit sales is what's called a uniform distribution. Every outcome is equally likely, right? You can see I could have different distributions in here, right? Is it just arbitrary? No, I might have to go back and look at data for past projects to see what kind of distribution fits it the best. But I might go and say, okay, the first one might be 1,100 at 235 price. What happens? Then that gets plugged in, NPV gets popped out. Then I do another. I have a simulation package which arbitrarily does it. The next one, it comes up here, 190. And units ends up being 900. It dumps those in, pops out another NPV. I do this, I could do this a million times, right? Because I'm not doing it, my software is doing it. Then it's gonna take all those million NPVs, it's gonna add them all up, be a large number, it's gonna divide by a simple average. All my NPVs added up, divided by the number of NPVs I computed. That's gonna be my expected value, my expected NPV. So you see how a simulation is a little bit different than a scenario? It's like a scenario analysis on steroids. Instead of like saying, here's exactly what's gonna happen, you fit a distribution to each of the variable inputs, each of the things that can change. And then you let the simulation software utilize those distributions instead of these fixed values right here. And the nice thing is, when you get this, you won't just simply get an expected NPV, you'll get a distribution. It may look like, maybe your NPV looks like a skewed distribution like this. So NPV, or excuse me, NPV, and then probability. It might look like that. And this might be your expected NPV right here, right? Maybe it's close to that 48 right there. But then, the nice thing about a simulation analysis is it fills in all this other stuff here. So maybe this is 48,000 right here, but maybe right here is 0, which means this is negative, and you want to know the odds, the probability that the project could go bad. What's the odds of being negative? Simulation analysis can show you that. It can say, for this project, given your distribution assumptions for your simulation, there might be a 7% chance the project has a negative NPV, and a 93% chance it has a positive NPV. So you get a little bit more information out of it. What's the downside of simulations? What do you think the downside of this would be? Running a simulation. Sounds too good to be true, right? Downside is there's a phrase, junk in, junk out, which means that if your assumptions for your distributions that you're using for the inputs aren't correct, then your analysis won't be correct, but you'll likely never know it. So you get flawed outputs, you get flawed decisions because your expected NPV is going to be flawed. Okay, what I'll try to do on Thursday, so Thursday we're going to start something called real options, okay? We're actually still going to be in chapter 13 for a little bit. It does some of that in that same chapter. Then we'll jump into chapter 14.